We're going to continue our discussion on Chapter 3 starting with some items that are excluded from gross income and wrapping it up with some special case transactions. There are certain types of income that are excluded from gross income. Fringe benefits that are offered by an employer do qualify if they meet non-discrimination rules, which means that they aren't benefiting like just the higher income individuals of the company or just certain departments of the company. It has to be available for all employees. So some examples of those fringe benefits are no additional cost services that are provided to an employee, like if you're working for a hotel and you're able to use unsold hotel rooms for free, or an airline that allows its airline employees to use unpurchased airline seats to take flights. Any discounts that are provided to employees for products or services that are normally sold by the business. In case of products, the discount cannot exceed the gross profit percentage for the company, so the company can't give that product at a discount and take a loss. In the case of services, the maximum discount is 20% of the normal selling price. Qualified transportation benefits can be given to employees, and the employees would be able to exclude that from gross income. Some examples for that would be if a company paid for parking downtown, or if they paid for a bike share program or something of that nature. And also de minimis fringe benefits, those would be small benefits that the company offers to their employees, like if they hand out turkeys or hams for the holiday, or if they invite the employees and their families to a company picnic, that would not be taxable to the employees. There are some non-taxable fringe benefits that have limitations. Some examples of that are life insurance. The employers can only cover premiums for coverage up to $50,000. After $50,000, the employee would be taxed on that amount of the premium. For educational assistance, employees can only offer up to $5,250 that is reimbursed to the employee without it being considered income to the employee. For dependent care assistance, the employer can offer up to a $5,000 exclusion, but it cannot exceed the earned income of the employee. Some other non-taxable items, and some of these items have other requirements or limitations. Scholarships and fellowships generally are not taxable as long as they are used to cover qualified educational expenses. Qualified tuition plan withdrawals are not taxable as long as they're used for educational expenses. And starting with 2018, there is a $10,000 limit per year for any withdrawals from a qualified tuition program like a 529 plan for K through 12 private or religious educations. If you withdraw money from a qualified tuition plan that's not educational expenses, then that money would be taxed, and there are usually penalties involved in that too. Life insurance proceeds are usually not taxable. However, if you elect to receive life insurance proceeds like over a series of months or years and you're receiving interest due to that arrangement, then the interest payments on that life insurance proceed would be taxable. Gifts and inheritances are not taxable income. Compensation for injury or illness would not be taxable. Child support is not taxable to the recipient, and it's not deductible by the individual that pays it. Any welfare or government benefits is not taxable. And employer-provided adoption assistance is not taxable as long as it meets the requirements and limitations. And we're going to talk about that more in Chapter 9. Savings bond interest is not taxable if it's used to pay for higher qualified educational expenses for the taxpayer, spouse, or dependent children. There is a full exclusion allowed if the educational expenses are paid exceed the redemption amounts of the savings bonds. There is a limitation that applies if modified adjusted gross income exceeds $119,300 on a joint return or $79,550 on other returns. For the purposes of this class, I'm not going to ask you any questions that you need to apply that AGI limitation. Let's look at an example. We have Mark and Joan Washington, a married couple who cashed a qualified Series EE savings bond. They received proceeds of $9,000, representing the principal amount of $6,000 and interest of $3,000. They paid $7,650 of their daughter's college tuition. They are not claiming an American Opportunity or Lifetime Learning Credit for these expenses, and their daughter does not have any tax-free educational assistance. Their modified adjusted gross income is $80,000. So in order to calculate the bond, the interest for the bond that would be considered interest-free, tax-free, we are going to take the amount of interest that was earned on the bond, which is $3,000, and we're going to multiply that times the qualified educational expenses that were paid, which are $7,650, and we're going to divide that by the amount of bond proceeds that were received when they cashed in that EE savings bond. So when we perform that calculation, we are going to see that $2,550 of that $3,000 that was received in interest would be tax-free. So this amount can be excluded from income tax. However, that means they must pay tax on the remaining $450 in interest. So we calculate that by taking the $3,000 in interest that they received minus the excludable amount that's tax-free. We can also have a taxable interest in below market interest loans. If there was a debt instrument that's created with interest rates that do not materially vary from the market rates at the time of the issuance, then interest is required to be imputed. Some examples of when imputed interest does not apply are for sales of property for $3,000 or less, and sales in which all payments are due within 6 months or less. So if you have a 90 days same as cash scenario, then imputed interest would not apply. For gift loans, imputed interest will apply to gift loans over $15,000 where foregone interest is in the form of a gift. So the gift loans are put into place, or no, sorry, the imputed interest rules are put into place to persuade individuals not to give out loans that with below market interest rates and charge 0% interest when the market rate is 3%. Because of the imputed interest rate, any interest that should have been charged would be taxed to the taxpayer as interest. For original issue discounts on debt instruments like bonds, the amount that's equal to the difference between the acquisition price and the maturity value on the purchase of the debt instrument is the original issue discount, and that can be taxable. The holder must report part of that as income for every year. The original issue discount does not apply to tax-exempt bonds, U.S. savings bonds, debt with a maturity of 1 year or less on the date of the issue, and any obligation that was issued by a citizen of the U.S. before March 2nd of 1984, and also for non-business loans of $10,000 or less.